All right, guys, we might jump into it. A few more people jumping in, but that's okay. A few slides to get through today, so probably about 50, but I think all in all, we'll move through it pretty quickly because mostly summary points today. So I guess today, bit of a budget update on the 2023 Australian federal budget. Going to discuss things that recently came out, so GDP, inflation, interest rates, bit of an update on property, general share markets, the Australian dollar, tax residency, and what's happening on that front, as well as open it up for Q&A. So if we do have any questions at the end, please start dropping them in there. It doesn't necessarily need to be about the budget. It can be about tax. It can be about expat related things. That's why we're all here. Today, I can see that we've got just over, it's like people joining us from just over 16 countries. So that's pretty amazing. So I suppose good morning to those in Asia. Good evening or good afternoon to those in the US and the odd night hours in Europe as well. Wow, okay. So that's very interesting. So I suppose we'll jump into it. Starting off, as always, with a bit of a disclaimer. So anything you hear today, guys, it's not personal advice. Haven't taken into your personal situation, your objectives, financial situation or needs. Who being used just for, I suppose, general and I suppose when we look at the information that's coming out, it's just purely from the budget and updates. So no personal advice today. When I address questions at the end, if there are things that are, I suppose, too personal in nature, I might try and generalize the question a bit. But yeah, more than welcome to drop any questions in there and I'll get to them towards the end. So we'll jump into it. Okay, who is Atlas Wealth Management? So we're the leading provider of Australian expat tax financial advice and winner of multiple domestic and international awards. We're classified as tax financial advisors with the Tax Practitioners Board in Australia, clients in over 35 countries, and all of our financial planners are degree qualified with numerous postgraduate certifications. The types of services that we provide to expats is, tax financial advice, asset management, financial planning, some pre-departure reviews, repatriation reviews, and Australian mortgages as well. And that's through Jeremy Harper, which I know some of you have previously engaged with. Who are Brett and James, two great heads for radio. So Brett Evans on the left, founding and managing director of Atlas Wealth Management, and he is based in the Europe, Middle East and Africa region, now Dubai based, been over there for a few years now with his family. Myself, James Ridley, managing director for the Asia Pacific region in the Americas, and I'm lucky enough to be based on the Gold Coast. Very lucky there. Today's agenda, we're going to run through the budget summary, some key takeaways for expats and migrants. We always try and look at, I suppose, the migrant side as well. Not too much in there though. The Australian economy, tax residency, because that is still on the cards, Australian property update, Australian dollar update, Australian international equity market updates, and Q&A at the end. And as I mentioned, if you've got some general questions, throw them in there now. I'll capture them and address them towards the end of the presentation. No such thing as a stupid question either. Let me know when that slide has jumped over to the budget summary slide and then we'll just kick into it. Cool. Okay, let's hit it. Budget summary. So as I said, it's been a pretty soft budget. And I guess a bit of a safe or ballot box friendly budget as expected, with a focus on jobs, cost of living, home ownership and health. I guess with this light on budget, there's not much in there at all, except for it is small business friendly. So it is rather sensible given inflation. There are some things which have been legislated, which were announced the last budget, and they've only just been legislated, which is a couple of good things for expats. I suppose with this budget, we can see the government's being fiscally responsible in the short term. I guess when we look at the budget coming from the Liberals, it seems like the Liberals are becoming more left, whereas Labors are becoming more right. We'll look at just the general summary here. So not a typical pre-election budget full of spending promises. And I think we can agree that most of the spending has happened, I suppose, in the last 2 years with all the stimulus. Government would not have time to legislate many of this because we're going to the polls in May. Significant level of government debt and the government's desire to also be seen as being fiscally responsible, purely designed to address the increasing cost of living. When you look at Labor's budget reply as well, which came out a few days later, Theirs was also very conservative, not picking up too much, not sort of attacking, I guess, the Liberals too much either. I guess from the Labor side, you know, I really believe that if they open their mouths too much, they're really going to screw themselves when we go to the polls in May. So I think they're just being quiet, to be honest, because I think right now they are in front. The net debt. So I guess when we look at this, it is a very sobering figure and number, and I guess not the end of the world in terms of capacity. And I mean that when we compare ourselves to other countries as well. So we can see there with that black line, it is trending up towards 37% by 2024 financial year. Now, if we put this in perspective to other developed countries or developed economies, right now the US, their, I suppose, gearing or net debt level is 128% of their GDP. And then if we look at the UK, it's 86.58%. So we're actually quite low compared to, I suppose, some of our major trade partners, which is good. It's very manageable, even though it is tacking up to 37%. I guess to put this a bit simpler, let's say, you know, we own a house and the house represents the economy, GDP. If we've got a mortgage on that house, the mortgage is worth 37% of the value of that house. So as an example, we've got a house that's worth $1 million. The debt that we have on that is $370,000. So that's actually a rather healthy loan to value ratio when we look at it from that perspective. We're not sort of geared all the way through our teeth like the US. So that being said, yeah, still okay. It is going up, but it is okay. It's something we can handle. Key beneficiaries from the budget. So low and middle income earners on less than 126,000. So changes to the low and middle income tax offsets are all getting a little bit of a kick up there. So $420 cost of living tax offset when we lodge our tax returns. That's good to see for everyone that's on that threshold. Social Security recipients eligible for $250 cash bonus in April. Small business relief for future PAYG installments and cloud-based incentives. So that was really good to see. The government's really, I suppose, incentivizing everyone going to the cloud, significant investment in IT, being able to claim a lot more. So we are sort of being encouraged to shift towards that. So that's a really good theme that's developing. Households and businesses, 6-month halving of fuel excise. So again, what was proposed is really short-term cost of living measures to assist, but not much at all. They're really trying to be sensible when it comes to, I suppose, the spending right now, just also because we are going to the polls in a month or two. Budget forecast, so GDP, gross domestic product. We would say that, yep, the government, it's being conservative with these numbers. At the moment, there are a record amount of cash in savings accounts and offset accounts in Australia. And now that we are breaking away from COVID, there's been a build-up of projects such as construction and infrastructure. So we expect that we'll see a bit of a surge now, next year, and then obviously tapering off and normalising. I mean, with the economy expected to grow above trend over 2022 and 2023, and the return to normal growth following that year. Some of this growth is due to high commodity prices, which have risen recently in response to supply uncertainty associated with the Russian-Ukraine conflict. Consumption growth, it's also expected to be higher than average as a rundown of savings from that have been built up during the pandemic. So that is good for our local economy. That'll obviously help things pick up, and they already are picking up, to be honest, now that a lot of the lockdown measures, vaccination requirements, those sort of things are starting to be relaxed in Australia. Inflation. As we look at inflation, I think there's two key figures here I want you to just remember in the back of your mind, because I'm going to refer to it very soon. So that's the 2022 financial year amount of 4.25% and the 2023 financial year amount of 3%. Those figures are quite important because I want to refer to them on the next slide. So we can see here, yes, inflation is rising at its fastest rate since around 2010, 2011. We're nothing compared to the US, which is really, really good. This time inflation is rising for several reasons, including supply chain disruptions, oil price escalation and increasing food costs. The Treasury forecast suggests that inflation is likely to be transitory to some degree. I guess it's going to be depending on how they handle interest rates as well and drive that down. And if Russia and Ukraine crisis is here to stay for longer than, say, 6 months, then yeah, we're going to really feel that. If we look at the next page, and again, drawing on those two key figures, 4.25% this financial year and 3% next financial year, let's look at wage growth. So I suppose when we look at wage growth in the 2022 financial year, 2.75%, and then 2023, 3.25%, we can see here that inflation figure for 2022 was 4.25%. So that means that wage growth is technically negative for the current financial year because inflation is so high, or predicted to be so high. Whereas for the 2023 financial year, wage growth is predicted to be just above it. So it does mean that we don't really have wage growth predicted at all for the next 2 years as a minimum. So that is a bit of a concern because that is one thing that the RBA keeps harping on about, where he wants to see wage growth, but you don't really get wage growth when inflation is higher than, I suppose, wage growth percentage year on year. So it's a very difficult task. But I guess when we look at the latest official wage price index, yep, annual wage growth was only 2.3%, so very low. The budget now anticipating stronger wage growth in the next remainder of the 2022 and further escalation in the next 2 years, but still not enough to outpace inflation. Key takeaways for expats and migrants. So again, soft budget, so not too much in there. At the moment, tax residency rules, they are still proposed. So I know a lot of people are on here today to see if there is a significant update, whether it's changed, or whether I suppose they're going to push it out. Unfortunately, it's still proposed to go ahead 1 July 2022. So we'll talk about a little bit on that shortly. The new super rules, so putting more into super, and I suppose this is quite important for expats, especially when they choose to repatriate. So from 1 July 2022, the removal of the work test for making super contributions from those aged 67 to 74, and transferring the work test to claiming a personal tax action for the contributions as well. So previously, we always had this cutoff where we had to meet this work test to make large contributions to super, that being after-tax contributions. But that being said, they've now changed this legislation, so it does mean that returning expats that are coming back to Australia to retire, they can actually squash a lot more into super for a longer period, which is really, really good. Probably the biggest challenge that sometimes we have with our own clients is trying to work out the best way to shoehorn as much super before this key age of 67 when we potentially aren't working anymore. So yes, that does create greater flexibility. The other one is extending the ability to bring forward 2 years of non-concessional contributions from age 67 to 74. So the types of contributions we can make to super or types of contribution caps, there's two. There's concessional contributions, which is pre-tax. So whenever we put that amount in, a 15% contributions tax comes out of it. Our annual cap right now for that is $27,500. An expat might only use that to offset some capital gains or maybe some other income, which will be taxed quite high at non-resident rates. The other type of contribution is non-concessional after tax. So the annual cap for that is $110,000, or if you're triggering forward 3 years worth, that's $330,000. So the fact that we can contribute a lot more later in life is great. It's advantageous because when you look at, I suppose, moving a foreign pension or savings into super, we've got this opportunity now, so preventing some tax leakage, maybe when selling down a CGT asset or an investment property or shares, being able to use this update much later in life. So transferring wealth into super, where when we turn super into an account-based pension, it's then tax-free from the Australian tax side. Depending on where you're residing, there might be some rules around how they would treat or tax super. I know personally the US, they're not very friendly on superannuation accounts, much like Australia doesn't really provide some sort of relief on a 401k or an IRA. So just be mindful of that. Some other takeaways for migrants. So the budget announced the program numbers for the 2023 permanent migration program. Planning levels will be maintained at the current level, 160,000. So that's good news. They've kept it on as is. In addition, 10,000 places in the 2022 migration program from the partner visa category. it's going to be redistributed to the skill stream, resulting in an increase in the skill stream ceiling. So that's all good news. It's a shame that they didn't just add the additional 10,000. They actually took the 10,000 from the partner visa category. 10,000, it's honestly not that much. And it's probably what our economy needs, to be honest, now that all restrictions are coming down. Moving through it, so into the Australian economy, and I suppose always a common theme with the Australian economy is spending our way out of it, given that there is just so much excess savings money sitting in offset accounts that can be used, that's been built up. So we always refer to that built up as just capacity. There's a lot of spare capacity that can be used. Australian GDP. So if we look at graph 1, I suppose we can see in 2021 to 2022, you saw there a big breakout from the lockdown, a ramp up in growth post-lockdown on the GDP growth graph. Huge, big spike there, and that's just from the lockdown ending. And then obviously you've had some states go back into sort of little lockdowns. Probably the most one that's been voiced in a lot of, I suppose, media outlets has probably been WA. Queensland was pretty bad, but WA has probably been pretty similar, to be honest. But they're slowly relaxing that now. And we can all see, a quick recession, 2-quarter contracting, and then Australia reopening, which, it ramped up GDP growth, and then obviously a bit of a contraction there again. I suppose when we look at graph 2, and when we were presenting these slides last year, when we look at the difference in contributions to GDP growth, it's amazing how much contributions to GDP changes in 12 months. So compared to last year, nothing was contributing to GDP growth due to COVID. We were actually net importers. The biggest contributors last year were the government stimulus and imports. This year, government, still one of the biggest contributors, which does make sense, but all categories have picked up and importing has dropped, which is pretty normal for Australia. Surprisingly, not a lot of mining investment. So resource companies don't see the recent surge in commodity prices as a push to invest more, as they likely don't see the current prices as sustainable. They likely see it as probably short term. It's an interesting thing that's come from that. Foreign GDP growth. So I suppose, major trading partners there. So China and India. China not doing too well right now due to the COVID zero policy and being in lockdown. There's a lot of major cities in China which are in lockdown, and right now, China does actually have quite high vaccination rates, but they're just really pursuing this hard line on COVID zero policy, which is just stalling their economy, to be honest. It would be good if they moved to the ways of the West and just moved to living with it, but not sure whether that will happen. But seriously hindering their growth. And we've also got that declining property market over there as well. Everyone was reading about in the publications about Evergrande that happened last year, and the volatility it caused briefly in the market, probably a few weeks, and then coupon payments were made, and then off they go, and then markets rallied quite quickly after this. Recent trade agreements with the UK and the US, so that's going to help us going forward. Eurozone, naturally, we can see slowing down just with everything going on over there right now, and Japan has also stalled for the time being. But I suppose towards the end of 2021, leading into 2022, you can see what looks like Euro was kicking, which is good to see, but that would have, I suppose, stopped now. And unfortunately, I am a little bit colorblind, so that's not going to help me, but it looks like the US was kicking as well, but that's probably going to stall a little bit now as well. But again, we'll have to wait and see what happens in the US with the interest rate rises as well this year. Inflation. So Australian Treasury and the RBA have insisted that the current inflation is transitory, but that argument is waning. So how transitory can the inflation be? It's going to be interesting to see what happens, I suppose, the rest of the year and leading into next year as well. As we've seen in this year's budget, many measures were about finding a short-term solution for the rising cost of living. So they believe, inflation and the recent spike is short-term, and that's why the measures are short-term. And we'll have to see what happens towards the end of the year, whether inflation is starting to drive down, because maybe the RBA has moved a little bit on interest rates as well, and see where we sit. But interest rates, intrinsically linked with inflation. So the RBA whether they like it or not, they are going to have to move. This morning on the Australian Financial Review, you saw Westpac and a few of the other banks revising their recommendations that, yeah, they think the first rate rise will probably be in June. I think it's pretty normal to support that. I just think that somewhat the RBA is being bullied into lifting rates early when you might already have another rate rise in the US. US Federal Reserve taking a hard and fast approach to managing inflation with a rate rise in March and two forecasts now, in May and June. So hopefully this hard and fast approach that the US is taking isn't going to stall the economy over there. I mean, when we look at UK, they're sort of taking an approach that inflation is transitory, taking a wait and see approach and just seeing what happens. They've already gone twice to the Bank of England, so they have lifted rates. They haven't just stopped, but now they're just waiting and seeing to see whether that helps. I suppose the concern is, can those who have bought up property in the last sort of 12 to 24 months weather the storm in Australia if interest rates climb quickly? So we don't want to see a shoot-through effect where interest rates go very hard, very fast, but we're already starting to see mortgage and personal loan default rates climb at a time when debt's rather cheap. So we would expect that would have a flow-on effect to a degree into the property market. So we'll just have to be mindful of that, but we'll talk about property soon. We've got some good data packs out from the ABS and APRA. The labour market, so yeah, wage price index growth, and something we already talked about just before, but yeah, lack thereof. As you can see there, we really haven't had good wage growth for a number of years. And I guess it'd be great if we could get back up to the days where wage growth was, above sort of 3.5% year on year for a long time. But right now we're really dealing with inflation. The government's really got to get up their arse and try and help us with this. But their biggest, I suppose, task right now, and mainly for the central bank, is how to deal with inflation. But yeah, we've had really poor wage growth for about 10 years now compared to other countries like the US. Labour market. So I suppose the labour market, it's the be-all and end-all to getting our local economy firing full steam once more. We commonly hear the government talk about unemployment, but we also like to consider the underemployment, which is ordinary full-time workers put back on part-time work, and the same with part-time workers or those who aren't working but have not sought Centrelink benefits. So when we look at the graph on the left, we can see that underemployment and unemployment is at an all-time low, probably 14 years. So that's really good. But there's also still capacity when we look at the right, because we can see there that job vacancies and advertisements are going up. So we've got this gap that's developed. So I suppose migrants will be probably a bit of a key there and likely assist with filling the gap in those vacancies. The key challenge for the government is that everyone is actually a little bit scared to come to Australia because we had such hard and fast border rules when COVID kicked off, and we still do have some unique border rules with vaccination mandates, booster shots, those sort of things. So if we can't solve that problem, we're likely to have a bit of a slowdown in economic growth. I think pre-pandemic levels, we were probably number 2 for migrants when they were leaving home to, I suppose, go out and search for a job in another country. Now we're ranked about number 14, and it's mainly just due to our hard and fast rules, people getting turned away at the gates when they come here. So they need to really fix that, and hopefully that gets a lot better over the coming 6 months when border rules just do come down because vaccination rates are just so high, herd immunity. Rates may not stay on hold for too long. We know this. It is going to start happening. So interest rates, key driver of the economy, they impact currency as well as the property and share market. We can see here on the left the 10-year government bond yields in Australia, on the right, as well as the US, Germany, and to a lesser degree, Japan starting to turn a little bit there. They did actually start to turn sort of quite early. And I suppose when we look at 10-year bonds, they're a bit of a window into what's happening down the track or what the market is trying to predict down the track. So a precursor to any rate rises. We've been seeing fixed rates on mortgages lift from last year, pricing in rate increases. So it seems like every couple of months the fixed rates for 1, 2 or 3 years just lift. So they're pricing in obviously where the cash rate or interest rates are going. Rates are going up, whether we believe it or not, but the RBA will likely move on that in June. There's only one direction they can go. You know, I would expect that we'd get sort of taken up to 0.25%, then 0.5. We might get 1 to 3 this year, depending on, I suppose, the economy. One thing we saw recently was actually the bond yield in the US. So you might have seen in some publications about the yield curve inversion or the inverted yield curve, which is very rare when you see that come out, and it does cause a bit of a stir. But when we look at what's happening when there's a yield curve inversion, it means that the spread between the 2 and 10-year bond yields has long been regarded, I guess, as a great indicator, a great indicator of an oncoming recession, and as a phenomenon that can limit the Federal Reserve's freedom of action. So usually 10-year bonds will command a high yield for the sensible reason that more risk is involved in investing further into the future, and investors require a higher return to compensate for it. Whenever the curve inverts, it means that the 2-year bond yield's yielding more. It's taken as a signal that a recession is coming and that at some point soon interest rates will have to come down. So that's just a bit of a definition of when you see yield curve inversion. We haven't had that in Australia for a very, very, very long time. But when you see it happen in the US, it means that they're pricing in that rates will go up right now, you know, next 1 to 4 years, but then rates will have to come down in maybe 7 years or 8 years. So that's what it's trying to price in when you see the yield curve invert. And it's inverted twice now. It was once about a week and a half ago on a Tuesday, and then again on a Friday. So it's causing a bit of a stir at markets, bond markets. So headwinds for the economy. So Australia, it's in its early stages of reopening with most pandemic restrictions removed. Although there could be a slight drag on household consumption from higher energy prices, Australia is a large exporter of natural gas, coal and wheat, and our economy stands to benefit from commodity price increases. The labour market has tightened over the last 3 months, but wage growth has remained reasonably contained. So escalating conflict in Ukraine, it's more the indirect impact that's having, sort of increasing costs in cost of living, I guess, in general. Interest rate increases and lack of wage inflation. I suppose even with the main headwinds front of mind, global growth this year should be still above trend, provided hostilities ease, global energy prices stabilise. Above trend growth should support equities over bonds and cash, but the conflict has created significant uncertainty, which means we will see a common theme, which is market volatility right now. Next slide, tax residency changes. So we did harp on it about this last year. We had a few webinars about it, and I guess today I mainly want to focus on discussing commencing residency or the change. So commencing residency rules, not when we're first leaving and trying to cease residency, because most attendees today are already overseas looking at the countries and the numbers. So I haven't actually put too much in there about ceasing residency. My concern for my clients and most expats on this is if they accidentally commence residency. So unfortunately, the budget provided no insight into the current proposed residency rules. And I guess it does mean that, naturally we accept that it should be still going ahead as of 1 July 2022. When we look at what is on the government's plate and what's coming up in the next couple of months, there is a fair bit on their plate. So we've got to go to the polls in May. Then if we look at the process of getting this kind of legislation through, it's still got to go through the federal government, has to release an explanatory bill. Remember, when they announced these changes, they just said refer to the Board of Taxation report submitted in March 2019. So an explanatory bill still hasn't come out. So that's a bit of a question mark. Once the bill comes out, it then needs to go through the lower house, upper house, and then receive royal assent. So I will say there is still a lot of water that needs to pass under the bridge before we get to that point. We would expect that the rules will not be retrospective based on the Board of Taxation's report. So at the moment, we really wish we could shed more light on the changes, but at the moment they are still proposed to go ahead as is. So yes, bit of a concern there. And again, my main concern is to my own clients and I suppose expats in general is just these commencing residency rules. I think the one that everyone's focusing on is that 45-day test or that factor test. So I'll draw on that very soon. But when we look at the rules, current tax residency rules in Australia, right now, they don't include this bright line test, so it can be difficult at times to actually provide certainty on an individual's tax residency position. So there is a bit of grey in the current rules. So we're moving away from legislation that received royal assent in 1930s, the 1936 Tax Act. New rules are intended to consider a vastly different workforce and expat population. When we look at the primary test or this bright line test, that's actually very similar to a lot of other countries. The US has got one, substantial presence test. UK's got one. So it is moving in line with, I suppose, what a lot of other countries are already doing. So a person who is physically present in Australia for 183 days or more in any income year will be an Australian tax resident. Individuals who do not meet the primary test will be subject to secondary tests that depend on a combination of physical presence, measurable and objective criteria. So those are the factor tests. When we look at the framework, yeah, it's still based on that Board of Taxation report. The drawback of that report is it was submitted in March 2019, therefore it didn't account for a COVID-ridden world. So the concerns there is this 45 days doesn't really take into account the fact that we might actually be stuck in a country because we can't get out because of border rules or quarantine or whatever it might be. 45 days, it's not too much. We wish it was blown out to 90 days because that's a fair bit more time and flexibility. Commencing residency. So I'll run through this flowchart and then we'll jump into each of the factors as well. So yeah, commencing residency. If we're not a resident in the previous income year, find out whether you commence residency in this income year by the following steps. If you're a resident in the previous income year, turn over the page to see whether we cease residency. So I'll pull this from the report. So commencing residency, did we spend 45 days more in Australia this income year? So it is based off a financial year, not obviously crossing over 2 financial years. No, okay, we're a non-resident. Yes, apply the factor tests. Unfortunately, the way the factor tests are designed, it will capture, I would say, most expats, absolutely. The right to reside permanently in Australia, okay, Australian citizen, permanent resident, Australian accommodation, I'm going to talk about soon, Australian family, going to talk about soon, Australian economic interest, going to talk about soon. If we satisfy 2 or more of the factor tests, yes, stop here. You are a resident. It starts on the day you arrive. You are, and then no, okay, we're a non-resident. The way this is worded, including within the Board of Taxation report, is that if you came back to Australia, you bounced back and you came for a couple of weeks in October, let's say you came back for 25 days, and then you returned, you went back overseas, and then you came back again in May. This is the same financial year, came back in May and you stayed for, say, 40 days leading into the end of June. Because you've breached and gone over the 45 days, your residency technically would have started back in October. So that's probably what the concern is as well, the way it's made up. They need to provide further clarity on, yeah, okay, well, based on what they said, it starts on the day you arrive. Well, it's based on those 45 days. So when those days started, that daily count. So it does mean, yeah, you could accidentally turn your residency on in October from that first trip if you're not mindful of the 45 days. There is a tax treaty interaction, and I'll talk about it shortly as well. What are the factors? Yep, right to reside in Australia, Australian accommodation, Australian family, and Australian economic connections. So right to reside in Australia, we have the right to reside permanently in Australia for immigration purposes. This includes citizens and permanent residents of Australia. Australian accommodation. Australian accommodation, sorry, this is somewhat a bit of a grey at the moment. We need to see some clear guidance on this. And I suppose when we look at just how it's been laid out, so an individual is taken to have satisfied this factor of having Australian accommodation if the individual has an arrangement to access accommodation at any time during an income year. This factor should be satisfied where individuals have moved overseas and maintain ownership of and access to accommodation regardless of intention to sell or rent. However, where a property is owned but rented out for the entire income year, then that property would not satisfy the accommodation factor. So quickly, if we have investment properties and they're rented on the open market, that's fine. We're not going to satisfy the accommodation factor. If our main residence, we've chosen to rent it out on the open market, that is not going to satisfy the accommodation factor, that's fine. Within the Board of Taxation's report, they even included timeshares in holiday or hotels, I guess you could say, where you do get the ability to come back and live in that or stay in it for 12 to 15 weeks, depending on what the timeshare is. So that was actually included as part of accommodation. You could come back. So yeah, there still needs to be a fair bit fleshed out on this Australian accommodation factor. But I suppose when it comes to ensuring non-residency, the government really wants to start seeing expats sever ties and not having a foot in two camps. Australian family, so an individual will have an Australian family or tie or satisfy this factor if their spouse or any of their children under the age of 18 are generally located in Australia. So spouse will include partners in all de facto relationships. This is not expected to include estranged relationships. So right now, a lot of expats do send their kids back to Australia to border a lot of the Australian schools. So if we are coming back to Australia and we accidentally breach that 45-day factor test, because we will comfortably satisfy the Australian family factor, we could accidentally re-trigger our residency. So it's those things to be mindful of. Unfortunately, if they do legislate these kinds, this proposal as is, it could mean that a lot of expats, if they want to spend more time with friends and family, they will need to consider meeting outside of Australia, Bali or some other holiday destination. That is unfortunately the likelihood of these residency changes. Economic connections. An individual will have an Australian economic connection where they're employed in Australia, actively participate in carrying on a business in Australia, or directly or indirectly have interest in certain Australian assets. So with this next point, I've tried to summarise what is most pertinent to Aussie expats. These are, I suppose, what I would consider some of the key points. So taxable Australian property, so that's physical asset, that's investment properties, if we own mining assets that we're leasing, or even if we hold an indirect interest through, say, I would call it a listed investment company where we own more than 10% of that company or that managed fund. So to give you an example of what that is, if you were investing in an ETF, an exchange-traded fund on the open market, such as Vanguard Australian Property Market, if you own 10% or more of that ETF, so that's hundreds of millions of dollars, then that would actually be treated as taxable Australian property. So just bear that in mind. But there's not too many that fall in that category at all. A bank account with an Australian bank with significant cash deposits. So I suppose this has mainly been a behaviour where in the past, we've always encouraged expats to give their cash a purpose. So a purpose might be putting it down on debt, investing, paying off bills, obviously, putting in the offset account, that's a purpose. They're now looking to legislate this where, if we have significant cash assets, that's going to be considered, Australian asset or an economic connection. An interest in a family trust. So a lot of expats do have family trust back in Australia or a discretionary trust, and they might use it as a holding vehicle for some shares or whatever it might be, or property. That'll be a complicated one. It might be a case where we'll see a lot of rubber stamping coming from that, but I suppose you'll need to consider your ties and whether this will need to be wound up. Rubber stamping might just be a case where you're applying it or adding a new director and you'll take yourself off, or you're no longer the appointer or the settler or the trustee, and ideally, you're not receiving an interest from that or some sort of income or capital gain. So that's what they're looking at bringing through, or receipt of Australian social security payments in the preceding income year. So there are a lot of expats that do retire, especially throughout Southeast Asia. They still receive their social security benefits. So with that in mind, it does mean that very likely that, have a strong connection back to Australia, or will it be considered a tax resident. Australian property update. So really good one to talk about, because I think we've all seen what's been happening back in Australia around property, especially in the last sort of 18 to 20 months. It's amazing how quick the property had changed when COVID hit. I think around 2020, probably July, August, because interest rates had sort of hit their floor, property started to change. And it's frustrating that it started to change around August as well, because the government brought in the change in the main residence exemption. So expats were really shoehorned into making tough decisions before that date. And obviously we've seen the market sort of go on a bit of a bull run but I think things are going to now start changing with interest rates on the move. So I suppose there've been a lot of hotspots performing well, and as we know, lifestyle location theme still continues. People buying up, especially on the Gold Coast, northern New South Wales, Sunshine Coast, and some hotspots in New South Wales and Victoria. However, I'd say that, yep, key themes starting to emerge. Days on market for properties selling is pushing out now. Stock turnover is slowing, and then auctions are being passed through or passed in, so not meeting their reserves. So I think we could assume that 2021 prices are fading, and I guess expectations are being reset. Yep, interest rates are crucial. So financial markets are implying the official cash rate hits 1.87% by the end of 2022. That's huge. Don't think we'll be getting that high. That's translating to 7 projected interest rate rises this year by the RBA. Very, very unlikely. The cash rate is expected to rise in June for the first time in more than a decade. Yep, by 15 basis points, so take us up to 0.25. That's a mild interest rate increase. Most people that have a variable mortgage will see it, or it's already been priced in the last couple of months. Traders ascribe an 88% chance, the probability of a 25 basis point increase, and almost 50-50 on an outsized half a percentage point move. So that's just referring to state that, yep, maybe they'll take it up to 0.25 or they'll take it up to 0.5. So come June. But I guess I would say that a reasonable estimate would be we get at least 2 this year, 2 to 3. I think that's a good expectation. Future markets have forecast the official cash rate being 3% by August next year. It's currently sitting at 0.1%, so that's a big jump, going up by 2.9%. I suppose when we look at a lot of things that are in the way, you know, you got wage growth, inflation. A really good example of this is, okay, current New South Wales average home loan is $830,000. So if a variable loan went up by 2.9%, that's an additional $1,427 per month in repayments, or $17,124 per annum. Remember, repayments are made using after-tax dollars. They're not made pre-tax. So we've just done a rough estimate saying, okay, this is equivalent of approximately probably an additional income amount of $25,000 in that homeowner's pay packet. So when wage growth is at an all-time low, that is going to put significant stress, I would say, on a lot of investors or homeowners that have probably got a little bit high off cheap debt, and now it's changing. So it does mean that we will see a theme start to emerge. Banks' non-performing assets. So defaults are still a concern. It's a really good graph. So when we look at this graph, I suppose debt levels, and we look at the graph here back in the GFC, debt levels now have more so moved to mum and dads from businesses. I suppose the numbers don't lie, and I suppose when we look at this, the data that we're looking at right now, it's based on the end of 2021. It does take a while for it to come out, and the reason for that is that loans or debts, they need to be in arrears by 3 months or 90 days. So a lot of what we're seeing is actually from September 2021. So I guess the main point I want to focus on with this graph is that if we look on the right-hand side, this is banks, non-performing assets, otherwise known as people not paying their loans. So they're in arrears by 90 days. When we look at the dramatic spike by business from the GFC on the right-hand side, right-hand side, gosh, that's terrible. Now, we can see the defaults on the left-hand side around the GFC. Yep. Now, the reason why we haven't seen business spike again is because businesses are now running their business models a lot leaner with less gearing compared to pre-GFC levels. The big concern is the housing at 41%. During the peak through GFC defaults, it was 0.8%. So we look at it now and we look at the key figure, and it's sort of, it's just climbed over 1%. So that's a concern as interest rates are at all-time lows. So what happens when we start to see interest rates begin to climb? Defaults will increase naturally, and this will either cause more supply on the property market and potentially a property pullback, I think depending on the type of properties we own, where they're based, if they're in those premium blue chip suburbs, probably not going to see too much, probably moving into a bit of a slowdown. But yes, we are going to start seeing some changes in the property market where supply will no longer meet the demand. People would be trying to maybe cut their losses by getting out, paying off the interest rate changes on their loans. The next couple of graphs are maybe just a good look through what suburbs and areas are already in mortgage stress before interest rates go up. So a really good graph here, or just image I should say. So mortgage stress after you paid your bills, surprising to see a few of the eastern suburbs starting to feel it. Obviously, some of those western suburbs feeling it already, but this is before interest rates have even moved. So I'll have to see what happens over the coming 12 months. Melbourne, yep, you've got a bit of a mortgage belt there with Melbourne, and some really close to the inner city there. Again, this is all before interest rates have moved, so be interested to see what this graph looks like in 6 months' time. Actually, yeah, I'll probably do another webinar on this just alone because it'll be really interesting to see the key themes that have come out from this. Brisbane's doing okay, starting to feel it, but all in all still okay. Some key areas there, which you can see. But yeah, I think Brisbane's probably 5 or 10 years behind sort of Sydney and Melbourne when it comes to affordability. But some of the premium suburbs in Brisbane in the last 12 months have skyrocketed as well. Headwinds for property, yep, rising interest rates, no surprise. Little to no wage growth after accounting for inflation in the incoming years. Rapidly rising building costs. Recently in Southeast Queensland, we had the collapse of a major developer or construction company called Condev. They had in the pipeline 500 million worth of, I suppose, apartments, developments, townhouses, and that's all just come to a bit of an end. The way that's being worked out now, that other developers are swooping and taking over them, but the profit margin is not there for all of those developers, so they are taking on significant risk. But yeah, the fact that they had 500 million in, I suppose, apartment buildings here on the Gold Coast as well. There's some in Palm Beach, there's some in Main Beach. That's really stalled on those developments now, but it could be a case where we might see that more, that key theme actually develop a lot, become a lot more prominent with developers collapsing just due to rising building costs and all these fixed contracts that they would have secured a long time ago. The Australian dollar, so always a very difficult debate for expats as we're heavily relying on a rising or falling dollar, depending on which way we're going. And I suppose the common question that expats always ask themselves when they're sending back some savings is, oh, do I do it now? Do I wait? It's a really tough question. And I guess no one's got that crystal ball, can't predict the future. Therefore, more of a non-emotional way to send money back is obviously do it in tranches, dollar cost averaging, because you don't want to sort of be in a situation like back in 2010 or 11 where the Australian dollar got up to $1.10 USD, and then you've lost a significant amount of wealth because you've been hoping that the Australian dollar would get down to 60 cents or something like that. We can see through this graph, yeah, there's been some risk on and risk off, some dips and I suppose switching into little bull markets there. We can see as the year kick-started in January, the Australian dollar was actually being shorted as we entered sort of January with that big drop. We can see that sort of towards the end of January, or I guess halfway through January, it started to drop significantly. I think that's mainly due to the fact that people would have moved quickly into the US dollar due to the Russian-Ukraine crisis. The US dollar is always treated as a natural safe haven, being the major trade currency. So when there's some sort of crisis going on, a lot of traders will move to the US dollar. They'll sort of cancel their positions in foreign currencies and move quickly. And then once things settle, move back out to those other currencies. More recently, we've seen the Australian dollar. It's pushed up quite high. And that's mainly just been due to our commodity prices. We are a commodity currency, much like Canada. And therefore, when commodities prices are rising, our Australian dollar benefits from that. When we see an interest rate increase or a change in our local interest rates, you could see the Australian dollar actually drop a little bit. So And I guess if it was a case where interest rates stayed on hold and commodity prices fell, you would actually start to see the Australian dollar back in the 60 cents. But that scenario is very unlikely. Interest rates are going to move, and commodity prices might stay high, but probably short term, depending on everything going on with the Russia and Ukraine crisis. AUD, all about the commodities. So I guess right now, conflict in Ukraine, yep, driven up commodity prices, including energy, as well as other commodities like wheat. China unwinding the ban on Australian coal has also inflated prices as well. So this is good for us. This is good for our local economy. This is good and obviously strengthens our currency. How long it can last for, hard to tell. That far right one, the spot price, no one pays the spot price. It's always locked in future. But it's very interesting to see the export prices there. Spot price has gone very high on that coke and coal, but yeah, no one pays the spot price. Australian dollar versus the US dollar. So we are in that recovery phase. The US dollar tends to weaken when we are in recovery phase. We've got the US Fed tightening as well now. So with the beginning of the tightening cycle, it usually penalises the greenback and favours the Australian dollar. So we are seeing that happening, and that's why Australian dollar has further been supported. Or you could say that it is just a case that the US dollar has depreciated a little bit. The Australian dollar has appreciated in 6 of the past 7 Fed cycles, not including this month's interest rate rise, which was the first for the US economy since 2018. So that's last month when we actually saw the Fed jump 0.25. It was good to see. Markets ate that up and loved it. When we look at the US dollar, yep, it's made gains this year early on the Fed hawkishness and safe haven appeal during the Russia-Ukraine crisis. It should weaken now, and it'd weaken further if hostilities over Russia and Ukraine actually started to subside. So lower inflation outcomes later in the year lead to less Fed tightening than markets currently expect. So I would say that if in the next couple of months everything settles with Russia and Ukraine, US dollar would also settle as well. Traders short the Australian dollar as a hedge against deteriorating risk sentiment in the lead up to Russian invasion of Ukraine. This is at the start of the year, but the currency's resilience has forced them into buying to cover those positions, adding fresh momentum to its advance. So that's what we're seeing right now, the Australian dollar running up a little bit. Australian international equity market. So a lot to digest for the first quarter of the calendar year. You look at how the US market performed, you look at how most share markets performed, they're all in the red, and most are in the red for the March quarter. I think the biggest drop that we saw in Australia was actually January 27. So it's a date that not a lot of us remember, but January 27, the ASX 200 actually dropped 10% from the start of the year. And then we were mainly focused on what was going on in February because of everything going on with Russia and Ukraine, the concern that was happening over there. Very interesting to note that when markets aren't efficient, so if we consider an efficient market, it has access to all the same information at the exact same time as everyone. On February the 24th, that was the day in which the first missile went over into Ukraine. Now, leading up to the end of the ASX closing that day, there was just constant news and fears that, yep, the outbreak was about to happen. On that day alone, the market dropped, and it dropped probably by about, I would say, 2 or 3%. Now, on that same day, as soon as markets closed and then the US markets opened, that's when the first missile went over to Ukraine. The US market on that day actually lifted close to 2%. So very interesting seeing the gap in access to information when you look at that, I suppose, when considering an efficient market hypothesis. So this graph, we've just pulled this from CNBC. When we look at the start of the calendar year, from 1 Jan 2022, we can see that a lot of our dips have actually been caused by Jerome Powell, and mainly, everything going on about inflation and the hawkishness of the Fed and its interest rate lifts. That's pretty evident there, pretty much on par with the dates that it was being talked about. I suppose with the drops, it was caused by a large amount of people pulling out of the markets. What we would say, though, is that usually when you see these big drops, you would see the bond market lift. However, we didn't see the bond market lift. It just came out of equities. So we would say that a lot of the money that came out of markets was leveraged money, so buying on margin. we know that the ASX, it's actually recovered very well since the start of that big drop that we saw at the end of January and a little bit in February. We're almost above water again, I guess you could say, for the calendar year. Remarkably, the FTSE 100, the UK FTSE 100, it's actually done the best out of most developed share markets. It's actually in, I suppose, the black at the moment. It's in profit by about 1 to 3% for the calendar year today. So it just goes to show, even though they're quite close to the conflict, they're actually doing quite well over there. It's mainly because they're behind us and the US and a few others when it comes to the recovery. The S&P 500, so we can see they're still below water at the moment, but we've seen how quickly the S&P 500 can actually rally. When you look at March and sort of the big jump there, that was actually after they moved on the interest rates. So I'm just looking here. So when the interest rate went up by 0.25%, the market ate that up. They loved it. It created some certainty finally. Because I would say the market had priced in what was going on in Ukraine and Russia, as well as it likely priced in a 0.5% increase. So in the US, the desired cash rate is actually 2 to 3%, and that's treated as a neutral position. So there's still a few more rates to go to get there, quite a few actually. Rates are going up, but the economy, it can still grow and function with the official cash rate 3%, same with ours. I suppose, yes, it might mean that as investors, you can't afford 5 houses, but you can still function, you can still have your smashed avo, but just not all these different properties. Market is a perfect mechanism for pricing. So if you consider share markets as a whole, the US, Australia, and I suppose it being an efficient market, right now they are lifting, they are sort of pointing towards that recovery and steaming on. There is still considerable volatility up there, but it is good news. Markets are lifting. So I think we're just moving to a period where when you look at growth, we're not going to have the same kind of growth that we had for the 2021 calendar year. You know, that was probably a diversified portfolio, might have done double digits above 12%. A lot of balanced growth, high growth might have done a lot more than that. We're not going to see those returns again. You know, we're probably going to see half those returns on an average. So it's important to recalibrate your expectations when you're looking at your own investments. Market commentary. So sell-off in government bonds is supporting the equity markets. The current resource boom is underpinning the performance of the Australian equity market. The yield on the US 10-year Treasury note fell below the yield on the US 2-year Treasury briefly on Wednesday in US trading. So that was that inversion I mentioned. Inverted yield curve. One, I suppose, adage I'll throw in there is the market is very disordered right now with central banks moving to quantitative tightening, not easing, and increasing interest rates. So there is a lot that the bond markets are absorbing. So it does keep sort of whipsawing into an inverted yield curve, which does mean that they're trying to price in an interest rate decrease, but in 10 years' time. So that usually alludes to a potential recession in the US. It's a really difficult one at the moment. The VIX. So a lot of people would have heard of the VIX. It's probably polar opposite to most share markets, to be honest, for good reason. So the VIX index, it's a popular measure of the stock market's expectation on volatility, and it's based off the S&P 500 index. So when we consider share markets, they price in everything, and markets temperature, or what's pricing the market's temperature, is the VIX index. So markets change quickly by pricing in. So it is a reverse market. So if we just look at the start of the year and we look at January, the VIX jumped very quickly, and that's pretty much on par when we started to hear that interest rates were going to go up, and there was a bit of tension with the Ukraine and Russia crisis. Leading into February, it dropped significantly, and then we can see there it's picked back up in February because, Ukraine crisis kicked off, inflation figures came out. In March, we knew interest rates were going to probably happen early in March for the US, and they did. So you can see that big spike. But you can also see that the markets loved that there was an interest rate increase, created some certainty, and it settled markets. So we're now at a pretty good level at the moment. I would say that as we lead into the next week or two when we hear from the Fed, or even next month, you always note that the VIX will tend to sort of peak up towards the Fed or central bank's announcement, and then it'll drop off after. So pretty common that we see that happening. In terms of the next slide, it's just now time to move on to Q&A. So if you've dropped some questions in there, I'll do my best to get to as many as I can. There are a few that have come through. There are some that are quite personalised, so I might try and make them a bit more generalised in nature. Just going to have a drink of water and then I'll read them out. We'll kickstart. Okay, a few around the residency rules, which makes sense. So we'll jump into that. Just going to get rid of that. There we go. Okay. I've got some that a few expats sent through before, so I might address them because they are residency and it might actually help some of these questions that have already been asked. So first one was, if the new residency rules are in play, how does the DTA tiebreaker test apply? It's a good question, actually. I didn't talk about that. That wasn't in the slides. And I know you can't see me, so let's have a look here. I'll just bring that camera back into it. There we go. So, and I've just brought up an old slide that I had. So within the proposed residency rules changes, there was a provision to accept that they would rely on the tiebreaker test within a tax treaty. Now, just be mindful that a lot of countries do not have tax treaties with Australia at all. So common countries, there are a few in Europe, actually a considerable amount in Europe, there's a considerable amount or a few throughout Southeast Asia, a significant amount in the Middle East. A lot of them don't have any DTAs because it is, I guess, to a degree, tax-free area. So the way that the treaty interaction applies, and I'll just read out what it was stated within the Board of Taxation report. It said, an individual is otherwise a resident based on the ceasing residency test and is also a tax resident of another country with which Australia has a double tax treaty. A provision should be added to the revised residency rules such that if under an analysis the tiebreaker test of the relevant treaty would find that the individual is a resident only of the other country for treaty purposes, then for Australian tax law purposes that individual would be a non-resident. So that just means that even if you're outside, say, the UK for more than 80 days, 90 days, 100 days, but you're still treated as a UK tax resident, then in that instance you would be a non-resident. Now remember, this was a proposal as part of the Board of Taxation's update. It hasn't been legislated. We haven't seen that explanatory bill, so still reading from the tea leaves. But if they do bring that in as part of the new rules, that's actually a really good saving cause for a lot of expats that might be stuck in Australia or bounce back for more than 45 days in that Australian financial year. That's a really important one. That's a good question. If we have a look at another question here that I'm just going to read out, let's have a look here. Just reading through it. You mentioned superannuation and putting more in older age as we get a bit older and repatriating. Is there a way to transfer a 401k into super? Really common question that we get asked. Unfortunately, there isn't. 401k is a completely different retirement vehicle or tax vehicle in the eyes of the ATO. There is no scheme that you can roll it over into a superannuation fund directly, nor a self-managed super fund. The US frowns heavily on SMSFs, self-managed super funds. The only scheme that exists for foreign pensions and superannuation is actually through the UK pension scheme system, which is where you have a self-managed super fund which gets registered on the HMRC's list through a QROPS, and it's recognised as a QROPS, and then it does take a few, I suppose, months to sort of transfer it back into your SMSF, and then you've got to abide by the HMRC's tax rules for about 5 years to make sure it's used for retirement purposes. But no, that's probably the only overseas pension that the ATO acknowledges. And it's mainly due to a lot of overseas pensions access rules. As an example, 401ks, IRAs, you can access them whenever you want, but you just incur a penalty tax depending on how old you are. And then they're taxed at your ordinary US marginal tax rates. Whereas the ATO treats most foreign pensions, not just 401ks, but other countries, as a foreign investment trust, so a Section 99B, which means that normally the contributions that you've made into it, through, as well as the contributions that your employer has put in, maybe through salary sacrificing, they make up the corpus or the tax-free component in the eyes of the ATO. The other component is the earnings. So the earnings being capital growth from the investments, income distributions reinvested, that would be taxable by the ATO from the day the account's open. So normally it means if you're transitioning funds back as a bit of a pension scheme then, or sort of an income stream, a portion of it will need to be declared as foreign sourced income in your Australian tax return. And there might be some tax credits there that you can use as well. Having a look here, so I briefly mentioned the main residence exemption. This question's about, can I apply the main residence exemption to my current property overseas? So I guess probably a good scenario of that is, assuming you don't own property back in Australia and you've returned to Australia and you're now an Australian tax resident, but you still own that main residence and maybe you're renting out, yes, you can apply the Australians' rules, the main residence exemption, on that form of property that's overseas. So that means that assuming you don't own any other property, especially in Australia, then you can treat that as your form of main residence. So that means you can technically rent it out for up to 6 years, and that's capital gains tax-free. You would still need to declare the rental income and those sort of things to the Australian tax office through your tax return, but it means it does give you some time to decide when to sell it without capital gains tax applying to it. The only other item I'll mention in that is that you'll just need to be mindful of TOFA, so taxation of foreign accounts. So if you're resumed being an Australian tax resident and your debits and credits of a foreign currency moving between US dollar to AUD or pound or whatever it might be is more than 250,000, it is something that the ATO wants you to declare on your tax return as either a foreign currency gain or foreign currency loss. Deemed acquisition, or your cost base, would start on the day that you actually return to Australia as an ordinary Australian tax resident. Just question here generally about property in Australia. So everyone in Australia is saying property is going up, but you're saying it's going to turn. I suppose I'm saying it's starting to turn, and I only say that because I've spoken to real estate agents, and when they're talking about days on market, that's now pushing out. Days on market probably last year was, a few weeks, 2 to 4 weeks, depending on the property type. That's now pushing out to sometimes 2 months. Having to open houses and they go to auction, then they're not successful at the auction, so it doesn't meet the reserve, so it just goes up, offers over this. So we're starting to see that now. That probably kick-started, I would say, end of December. And then the other thing that we're seeing is just stock turnover is a lot less compared to sort of like September last year. And I guess it's just because expectations need to be reset that those 2021 prices aren't really there anymore because everyone knows interest rates are going up. So we will start to see a shift. Generally speaking, if we own property in good areas, good infrastructure development, property is not a short-term investment. So, we should be sort of shielded from everything that's going on because ideally the goal might not be to sell that property right away. But I guess, yes, we are going to start to see a change in the coming years, which is pretty much on par with interest rates changing as well. There's a few questions here, so I'm just scanning. There's a few about residency. Okay, good question here around super. Is our super part of the having a significant interest in Australian assets for the purposes of working out the status of whether you're a non-resident or an Australian tax resident? If so, then what would be the value? Yeah, good question. So under the Australian economic interest, superannuation was an asset that was listed. When you look at value, they did say any bank account over $10,000 AUD. So you would say superannuation, they might just include super just as super as a separate asset, not put a dollar figure on it, because unfortunately expats can't withdraw super or anything like that when they leave. So right now, based on the Board of Taxation's recommendations, any account over $10,000 was caught as some sort of Australian economic interest. Again, the way the factor tests are designed, it is a bit of a catch-all for a lot of expats. So if that treaty provision or recommendation with the treaty interaction is put in the new residency rules, there is going to be greater flexibility. My concern for my own clients is a lot of clients are in countries which don't have a DTA, so they need to be quite strict on their time back in Australia in each financial year. So be interesting to see how that happens. Another question here on family ties. Does it include brothers and sisters? So no, it doesn't. So it's mainly on, I guess, when you look at a spouse or financial dependents or anyone under the age of 18, so kids. Brothers and sisters wasn't laid out, cousins, parents, those sort of things. No, not that kind of, I suppose, family and how far away they are from you. When it comes to another question just around considered significant bank account balance, yeah, $10,000 was generally what they put forward in that report. There is always the sort of myth that goes around when transferring money back to Australia around this $10,000 amount in AUSTRAC. Just bear in mind, expats, that when you're transferring money back, AUSTRAC picks up every single transaction. So if you're transferring money back and trying to be under that $10,000 amount, $999 or $9,000, sorry, that probably looks more sus if you're doing that regularly. So there is no difference. AUSTRAC picks up everything. If you've got a clear history of being a non-resident, you've got nothing to worry about. You can send back 100,000, 500,000, doesn't matter. But AUSTRAC picks up anything. You don't need to worry about that. I think that $10,000 rule also comes from the customs card as well, which I think is now $15,000. Good question here, mainly specific to the US side. So can you comment on dual residency US and Australia as tiebreaker and how that works? Well, we do have a good DTA with the US, and I would say that if you're not meeting the bright line tests in Australia, so the 183A rule as part of the new residency rules, but based on the residency rules in the US, you are still a US tax resident, then you would be able to rely on the fact that you're a non-resident. And again, that's what's good about, I suppose, well-worded treaties and the tiebreaker tests. You can still be a US tax resident, bounce back to Australia for 3 or 4 months, and then head back to the US, and you're still a non-resident. Again, we haven't seen the explanatory bill. Very frustrating, considering it's meant to be, I suppose, submitted or I suppose legislated as of 1 July 2022. So just bear that in mind. Still waiting. There's a good question here. If the expat tax changed as of 1 July 2023, do current expats need to be careful not to spend more than 45 days in country in the prior year? And this is based on the financial year. So that's a good question, and mainly stating that, okay, if things are legislated not as of 1 July 2022, but they go ahead as 1 July 2023, do we need to be mindful? If I was being conservative, I would say yes, next financial year you do need to be mindful and careful of time in country, because if they are going to legislate it, they still might legislate it as of September. And much like when they introduced the main residence exemption, they announced that in 2017. It wasn't legislated until the end of December 2019. And then obviously it was effective as of 30th of June 2020. So they didn't give expats any extra time over that 6 months, because they said, listen, we gave you the notification back in 2017. We didn't say that it wasn't going to happen. We just took our time getting it legislated. So you should be mindful that next financial of your habits, bouncing back to Australia, those sort of things. If there is a tax treaty in place, very likely you'll have a bit of additional freedom there. But we only know what's been produced by the government, and right now, leading from, I suppose, tea leaves. Speaking to some accounting colleagues and tax colleagues, the ATO has pushed pause on a lot of residency rulings at the moment. They're waiting till the new financial year to see if anything is legislated. They're actually waiting till August. So the fact that they're waiting means they don't even know. They're seeing whether it's going to get legislated or not, and that's the ATO. So very frustrating on that front. Just scrolling down now. Good question. Is there an expectation that the residency changes might be retrospective or retroactive? Sorry. Not at this stage. It will apply as 1 July 2022. If you've got good history there, if your tax returns are reflecting non-residency, you should be fine going forward. It's meant to obviously provide greater clarity as to whether you are a resident or not. It does provide greater clarity, but one thing we didn't talk about was this ceasing residency test. So with the ceasing residency test, the new rules are proposed to be a lot more, our tax system is proposed to be a lot more adhesive to expats that are leaving. They like to see and know that you've got an employment contract in place of more than 2 years or 2 years plus, Australian accommodation in that place. And if you do, then that's okay. But they have stated that this overseas employment rule, which is just having a contract in place, is imperative to be able to cut ties with Australia. with your residency. So they are going to capture those expats that don't have, I suppose, a job lined up or a contract in place when they're first heading overseas and they're going overseas to search for a new job. Those kind of expats, they're not going to be able to deem themselves as non-residents until they actually have that in place. So it is making our tax system a little bit more adhesive to those kinds of expats in that category. But again, if you're overseas and you're not working, but you've been a non-resident for a couple of years now, you're fine. It's more so just those that are going to be living in the future. It's making our system a bit more adhesive. And then once they cease residency, then it's just a case where you follow the rules around not accidentally commencing residency. So that's factor tests again. Another good question here, I'll just read it out. If we have investment or banking accounts in a foreign location or on our permanent return to Australia, will these be subject to tax if they are not subject to tax in the local market? Well, that's a really good question. So right now, a lot of your shares that are owned overseas, even shares owned in Australia right now, if you're a non-resident, they're technically not taxable by the ATO. There's a few assumptions in that. Cash accounts, those sort of things, yes, they're exempt from tax right now when you're a non-resident. When you come back to Australia, the day that you resume your residency, well, that's deemed acquisition. This is when your assets are now treated or are assessable by the ATO. So on foreign currency accounts, technically speaking, I would say that, yes, you need to be mindful of TOFA, just what I quoted before, that $250,000 amount. And again, deemed acquisition is treated as the day that we fly in, that's when our cost base will start. So whatever, say, the Australian dollar and the US dollar is doing on that date, okay, that's when the cost base will start on that. The ATO is essentially treating us purchasing that foreign currency. And then if you're bringing that back in 12 months' time, maybe hoping for the currency to swing back in your favour, you will make a currency gain that you would have to declare to the ATO. So it's important to be mindful of that. Overseas shares, it's the exact same thing. If we're holding shares overseas in the US, Singapore, whatever it might be, we've received through our employment, restricted stock units, shares, there's plenty of different options that we receive in the US as well, two mainly. When you come back to Australia, cost base kicks in on the day you return. So deemed acquisition is taken. There are certain ways that you can navigate that with the US tax system, depending on the visa that you're on, to reduce overall tax exposure and tax leakage. But yes, deemed acquisition kicks in. There's a good figure here that a colleague has put in. Thank you, Lindsay. So just about property markets, clearance rates in Sydney and Melbourne are reducing below 60% now. Brisbane is still solid. That does make sense. As well as Adelaide still solid. So I didn't really talk about South Australia at all, but that's a really good fact. Thank you, Lindsay. There's another question here about, is there a limit on how much an expat can send home? Is there a limit to how much cash you can send home to Australia each financial year? There isn't. At the moment, it's just a case where when you're sending money back to Australia, it's completely open to you. This $10,000 rule isn't a rule. It's not a case when you're sending money back, and if you're sending money back more than $10,000, it's going to get caught out, or you have to declare it. You're a non-resident. The money that you're making overseas through work or investments, that's outside the scope of taxation. That's tax exempt to the ATO. When you're sending the money back, again, not taxable. If you're putting it in a cash savings account, well, you're a non-resident. So your bank or financial institution should be aware that you're living overseas, so they should be withholding a flat rate of tax or some sort of tax, usually 10% on the interest income. Interest income won't be much right now, but what we've seen in the past with a lot of expats is that sometimes the financial institution knows that you're overseas, but you haven't given the details of your country that you're in and your TIN, your tax identification number. That means that they're legally required to actually withhold 45%, which is the highest tax rate in Australia. That legislation piece was actually brought in back in 2018. So it does pay to give them your TIN. Some countries, they won't have a TIN. A lot of Asian countries do not issue a TIN to a spouse that isn't working, a trailing spouse. So there's usually a section on the form that you can say, yeah, country I'm in doesn't issue TINs for a specific reason. but there is no capital limit. You know, got clients that have sent home more than $1 million across a month. I've got clients that have sent back as little as $5,000 or $2,000. There is no cap. You're a non-resident. Probably the only thing I'd be mindful is make sure that you haven't let yourself go with having years and years of outstanding tax returns back in Australia. If you have assets here, such as an investment property that's producing rental income, that needs to be taxed at source. So you should be lodging an Australian tax return. It's amazing some of the cases that we've come across where, you know, they've owned a investment property portfolio. It's been in Australia. They haven't lodged a tax return up for 15 years. And where we tend to be the ones that give them the bad news, go, listen, you need to report this because you might have outstanding tax. Ideally, it's a case where they'd be negatively geared. So you don't have any outstanding tax, but just be prepared that, yep, there might be some tax payable for previous years. If you have assets here, you still need to keep up to date with your reporting requirements. And it's just good practice, good compliance, and it keeps the ATO happy. And that way you're never unsure as to whether your residency has been tripped up. There are a few more questions there, but they are a little bit too personal to address. So I might do my best to try and address some of them just in some email chains, just because I think that might be the best way to tackle it. You can see here just on this slide, yep, we are on Facebook. We do have our own Facebook group as well, Expat Financial Forum, where we just drop some links in there and hints, and there's always some good topics that get raised by other expats, and we just sort of meet at it, let it run, and we'll jump in if we need to. We are on LinkedIn, Twitter, and Instagram. Our Instagram skills are subpar, but we are getting better. Myself and Brett, we also run Expat Chat. It's a little sort of podcast. We try and meet every week and do it and talk about topics. A recent topic that we were discussing was self-managed super funds. We also have another podcast that I share with Jeremy Harper, Expat Mortgages. He's our managing director for Atlas Mortgages, and we mainly talk about really niche concepts for expats when getting a mortgage, issues they face, and then just some really key and good concepts as well. Outside of that, if you do have any ad hoc questions, feel free to reach out on the emails or drop us a line, whether it's on Facebook or jump on our website and submit an inquiry. That's easy. And I think that'll do it for today. Appreciate everyone dropping in, listening to me go on and harp on. If there is an update on residency rules that comes out soon, we will be the first one to be releasing an update, hosting a webinar and going through some actionable points and workable examples, but it's just typical of the government. They have announced it, so treat it as if it was going to be enacted as of 1 July 2022. I know that's not fair, but again, when we look at what they did with the main residence exemption, they didn't give expats time to move or make decisions. They gave you 6 months because they assumed that everyone was aware of it because it was announced in 2017. So just be careful there. Not retrospective, just applying going forward from 1 July 2022. In the meantime, guys, thanks for dropping by. I'll have the recordings out, I would say, in a couple of days' time, and we'll release the slides as well. In the meantime, have a good evening, have a good day if you're in Asia, and those that are night owls in Europe, sleep well. Speak soon.